Dude, I discovered Instagram last weekend. You know that?
You just discovered Instagram?
I just discovered Instagram. Like it's like a new social media thing for me. Like this new social media called Instagram, and it's awesome, dude. I'm obsessed.
You just weren't on it at all, or you weren't posting?
Well, I had an account because I apparently had 1,000 followers because people tagged me and stuff, but I think I posted once. It was me and Gary V. I posted it once and I was messing around with it. And I'm like, okay, well, it's at Brandon's event. Everybody there on Instagram. So I'm like, I got to get on there. And so I got on there last weekend and now I'm obsessed. I'm like, just freaking story. Like my whole life's on there. So if you want to know where I am, just go to Instagram.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, and welcome to episode 27 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson's husband, and I'm joined with the fearsome threesome again, starting with Mr. Jay Scott. How's it going, Jay?
Awesome. So I wasn't really paying much attention while we were getting started a few minutes ago. I was playing with, have you guys played with Gemini yet? The new Google AI?
The Google one? The Google Jet?
The one where they fake videos and they pretend to be able to do stuff that they can't?
Yeah, I mean, they faked it a little bit. I mean, they acted like it was voice activated AI and it was text, and they cut it, but it did that stuff. It's actually really cool. So if you guys get a chance to play with it, that's what I was doing when I was ignoring you guys a few minutes ago.
It does the same thing as Chat GPT-4, though, doesn't it? Like, basically,
yeah, it's just a question of, is it better?
Oh, well.
And so far, I haven't played with it long enough to have an opinion yet, but I'll let you know next week.
Does it write better love poems for your wife than Chat GPT does?
That will be the next thing I try, and I'll let you know next week.
Oh, come on. You already showed us your love poem that you wrote for her. Don't act like you've never done that.
I've done several.
Mauricio, how's it going, buddy?
I'm back.
Back from where?
Were you gone?
I was gone last week. You didn't miss me.
That's right. You were gone last week.
Now I'm hurt. I thought you guys missed me last week.
Episode.
I thought you missed me, even though I want to say thanks to Mike for covering. I thought you were like, wow, we were missing an integral part of the team, and you guys are like, who cares? Now I feel hurt. But anyway, I'm good. I'm ready to go. I'm ready to rock and roll. Pumped.
I guess I forgot to ask Jay, but I'll ask you, what are you drinking tonight?
I am drinking one of my favorite wines, go-to wines these days. It's so go-to. I'm actually using my Corvin to do this one. But the 2020 Lewis Cellars Mason, the Lewis Mason, not the regular Lewis, but the Mason specifically, is a tremendous wine. Highly recommend it. And there's no way I'm going to drink the whole bottle, so I figured I'd dig into the Corvin, which if you guys don't know what a Corvin is, it basically preserves the wine. You can do it by the glass. So I can pop a couple of glasses and then it doesn't take the cork out, so it just seals it and doesn't age the wine. So I can drink that thing 2 weeks later. So hey, Corvin, if you want to sponsor us, let us know. DM Jay Scott at sponsor.
I just use one of those little cheap ones with a button on it that you just keep pressurizing the button. That's the one I used. Jay, sorry, I skipped you. What are you drinking up there?
Doesn't matter. I had 4 bottles of this cab in my wine fridge, and so I grabbed one of them. And after tasting it, I realized I don't know where it came from, but I'm guessing somebody that doesn't like me gave me 4 bottles of this stuff. So
don't say the name. Somebody's gonna be like,
I'm not going to say the name because we might want them to sponsor us one day.
That's right.
AJ, how's it going, buddy?
Going good.
That's it.
That's it.
Just good.
That's it. Just good. I mean, like, great, amazing. I'm with you guys.
AJ, maybe it's because I missed last week, or maybe the last time I saw you was live and in person, but your beard is looking extra good today.
Just extra.
He was vigorously combing it before we started.
You know what? Now I'm doing a lot better. I'm doing a lot better now, guys.
Are you using a different different or a different, what are you doing with it? It's beautiful.
You noticed.
Yeah.
Wow, thank you.
Dude.
Head and shoulders on there.
That's right. Rid of that beard dandruff. Bad.
What are you drinking, AJ?
I got Red Bull in a red cup.
Solo Bull.
Red Solo Cup. Awesome.
AJ, are you with us? Are you with us for the entire episode, or you got to bail?
No, I'm here the whole time.
Nice.
Wow. We are in for a treat this episode. All four of us here the whole time. Wow.
Yeah, we're gonna have a good top 10 and game later.
I better have a good one ready.
By the way, that's impossible. It's impossible to have a good top 10. I think, is that how you said, a good top 10 or a great? That's not possible. Just so you know.
Well, how about you do top 10 next week then and see if you can beat me?
Dude, let's do it. I'm in.
All right.
I'm in
It's
for
a
the
bet.
challenge.
Okay, what are you drinking, Kyle?
I went cheap because I had to finish the bottle. So I'm going with the Evan Williams. I don't know if you could see that. The Evan Williams bottled in bond. You get this big tub for like the same amount as like a Maker's Mark or something like that. But little history for you guys. The bottle in bond, that used to be meant that it was bottled under the supervision of the U.S. government. So it meant like it was like quality controlled. But I usually use the Evan Williams for making my old fashioned, and I had a little bit left. So
Is that like a gallon of freaking booze?
yeah, pretty much.
Is that like buying wine by the jug?
Yeah, and it's 100 proof too, so it'll get you going there.
Well, it was overseen by the government. It's got to be good. I mean, government doesn't do things half-assed.
Well, but like if you want to talk about government oversight for something like liquor, that's one thing I will trust them on. Not much else. Speaking of trusting the government, there was a new bill that has just put before. You like that transition? There was a new bill that was put before Congress that proposes to force hedge funds out of the single-family home buying market. The bill, if passed, would require large funds to sell 10% of their housing stock every year for the next decade. This was put forth by Senator Jeff Merkley. He proposed the bill and was quoted saying, "The housing in our neighborhoods should be homes for people, not profit centers for Wall Street." So since I know AJ thinks the government should be more involved in regulating the free market, I'll start with AJ and say, is this going to help solve our housing problem?
Do you guys know who Jeff Jackson is? I like him. He's Congressman Jeff Jackson. I think he's out of North Carolina or whatnot. He signed and
Is he a Democrat?
Yes. And he signed and was pro this bill. And I was listening to him say, which I like him. I didn't like the fact that he was signing it. So I wanted to hear what he had to say. And it was interesting because I see completely both sides of this issue. Because first of all, I think it is an issue. And he talked about what's been going on and why the housing shortage is here, which the housing market, the reason it's going up, just to be very clear, has nothing to do with hedge funds. So the cost of housing, we still have not returned to anything. If we look at the year over year new housing on the market, we have not gotten back to anything prior to 2008 levels. So we just peaked in 2022 at 1.2%. And that's coming off of not even 1% for the whole decade prior. So we've not ever even returned to the United States putting out what they normally did per year. And we're a decade behind. So the housing shortage is a huge issue. And it's not one that can be fixed easily. And he talked about some of the things that have been going on, which he talked about, regulation and all this other kind of stuff. And he said that this is largely a problem due to regulation and what we've done in major cities and what's been going on. But he also then said, but I support us regulating this to do something about it. I found that just so interesting because I'm like, the problem that you just stated that is the major driver of this, you thought that they would be addressing that, but they went the other way. And I don't know if that's the right answer or the wrong answer, is not allowing hedge funds. I'm kind of actually split on it because I can see definite reasons why we shouldn't be letting companies gobbling up and competing with all the homes. I don't like this bill.
First of all, I'm shocked that you even said that. AJ, did you really just say that?
I'm sitting over here dumbfounded right now.
Can you say that again? I'm not sure I got something must have been going on. Did you just say that you thought that maybe the government should be justified in prohibiting free companies?
You're twisting my words around.
All right. So I don't know. I just want to make sure I heard it right.
I don't know that it's a good thing that corporations are buying up all the homes. Like, I don't know if that is a good thing. Right.
All right. That's fine. But you're not advocating specifically that we should be passing laws to change that behavior.
you know what? The laws that they're putting forth doesn't make any sense to me at all right now, but it's not that we don't do
You
something.
hesitated. Wait. You hesitated on there. Are you, yes, this is a yes or no answer. Are you in favor of government legislation to
No,
affect
sorry, I just heard government legislation. I'm sorry.
For a second there, I thought AJ was running for politics and he was worried that this was going to come back and bite him.
Are you running for city council of
Not at all. No.
Sorry, go ahead. Didn't mean to throw you off.
Now, I think when we look at the numbers, right, first of all, it isn't a problem. But at the same time, I don't know that if there's a huge disadvantage, it's not the market's not working properly. And no matter what it is that hurting home buyers? Is it not? Well, if we, the numbers, which should always come back to, we know why the housing is. Now, in June of 2022, by the way, the government states that a hedge fund isn't a hedge fund. So let's make that clear. They say basically anyone that has 50 million in assets plus, they're calling a hedge fund. So it's not necessarily a hedge fund. But institutional players, they just use the word hedge fund because it sounds scarier. But that's who they're talking about. So if you have 50 million in assets, which I think we're all disqualified, it doesn't allow you. So if your company has 50 million assets, you can't buy a single family home. That's what the law is looking at. Now,
can you start another company?
That's what I'm wondering. I'm like, can you just do shell company? They'll figure out a way.
They'll have a bunch of $45 million companies.
Yeah, exactly. But in 2022, institutional investors, they owned a cumulative of right around 570,000 single homes. Now, that sounds like a lot, but that's 18% of the market. Now, who owns
18% of the rental market? It's
rental market, just right. The rental market.
Yeah, because that's like less than 0.5% of the total single family homes.
Yep, exactly. And now the who owns the most? Investors do obviously own the most rental, which it's weird that they keep pointing that out, right? Like rental homes are being bought up by investors. Who else is buying a rental home to rent? But anyways, so there's around, the U.S. has housing units around 144 million. So the number, it's not like this is something of epic proportions that is destroying the market, right? I think largely this is a political thing saying we got to say we're doing something. And that's the political move to make because people are scared of hedge funds. So we're just going to do this big hubbubaloo. It will not reduce housing prices. They won't do anything to that.
Wait, why? So I'm sorry. So there's 500. So why? There's a bunch of homes that are owned by hedge funds or these institutional players over 50 million. If they have to sell those and can't buy future ones, doesn't that add to the stock of now people who are looking to buy homes? Isn't that going to allow? There's more inventory now. There's 570,000 new homes that are going to be available for mom and pops to go buy. Presumably
or for homeowners. Price. The point is that there's more for homeowners, so it should reduce the price of housing for those that want to buy their own home.
Yeah, but that's the thing. It's not going to fix it. It's not like these are evenly dispersed across the entire United States. Like there's just small pockets where they're buying all these homes where the numbers make sense and it's out of whack. So all you're going to do is all of a sudden those small pockets there'll be so much comes on the market that it'll actually tank the market there. And then all of a sudden these hedge funds are going to move on to the next thing and they're going to shift the market some way else.
Well, and two, it's important to know that just because they don't own it doesn't mean that homeowners get it. So over 70% of all rentals are owned by investors. They're not huge companies, right? They're not big mega corporations or anything else. They're just single family home investors. So just because a hedge fund's not buying it, right, doesn't mean that all of a sudden, we have all of these properties that are up for sale. In fact, too, I'd argue, well, then where did the renters go?
Well, so here's my issue. And number one, let me say that I think part of the issue that they're trying to address is that not necessarily where the numbers are today. So if you go back 10, 12 years, basically nobody owned more than 1,000 houses. We didn't have large institutional buyers of single family homes. If you go back just 10 or 12 years, go forward 10 years to 2030, and it's estimated that institutions are going to own something like 40% of all rentals. So I think the issue isn't so much where we've been, where we are, but where we're going, and the fact that this could make things a lot worse. Now, that said, my issue with this is, and let me start by saying, unlike AJ, I'm not universally against government regulation. I think government regulation is a good thing where the regulation makes sense and it's actually consistent. And unfortunately, that's very rarely the case. But I'm not going to take a stance against.
I'm sorry, I'm going to do this. We're going to clip that. We're going to clip that. What do you say? The regulation makes sense. So we're just going to clip that and then put it somewhere else.
No, it's true. I don't have an issue. I think that's part of the government's job. But the problem I have here is exactly what AJ.
Wait. Part of the government's job is to make more regulations?
Is to take care of the people. And sometimes you have to do that by regulating. And so, I mean, murder's illegal. That's a regulation. I don't assume you have any issue with that.
Nobody's told that to Chicago.
It's only illegal if you get caught, Jay.
It's only okay. So in theory, I have no problem with regulation where it makes sense and where okay. But here's the problem. As AJ alluded to and basically said, this isn't going to necessarily solve the problem it's trying or it's intended to solve. Number one, think of it this way: every house that was a rental that is now going to be sold off by hedge funds. Let's say that's 550,000 houses that are now converted to personal residences, and let's say prices come down. Great. Well, now we're going to start complaining that the rental market is too high because we have less rental inventory. And the rental inventory that we do have isn't as well managed because it's not managed by large companies that have the reserves to ensure that roofs are repaired and leaks are repaired and those sorts of things. And then we're going to start complaining that mom and pop investors aren't doing a good job of managing the rental inventory. There's not enough rental inventory. Rents are going up and people can't afford to rent. And so we're basically moving the problem from one side of the ledger to the other side of the ledger, homeowners to renters. The other thing I dislike is why are we arbitrarily drawing a line at $50 million?
Yeah.
I mean, if owning rentals is bad for the economy, then it's bad for the economy. And it doesn't matter if you own one of them or 1,000 of them or 10,000 of them. And so you can't argue that owning 10,000 rentals is worse for the economy than 10,000 people each owning one rental. And so we're just drawing an arbitrary line, and we're basically saying we're going to tip the scales in favor of one group of business owners and out of the favor of another group of business owners, and that just doesn't make sense.
I feel like they want to draw the line somewhere though, because they don't like the government's all about supposed to protect the little people, right? Like the middle class, lower class, and one of the best ways to build wealth is for them to pick up a small rental and something like that. So they don't want to cut them out. They just want to cut out the greedy hedge funds as you'll do, and that's in.
But nobody's arguing that the government's doing this in favor of small landlords. They're supposedly doing this to get housing prices down, and it's just not going to do that.
They're not trying to get people to actually buy rentals. That's what they don't want. They want inventory so new home buyers can buy. Which too, it makes a couple things. They're also still allowing though foreign nationals and foreign countries to buy rental properties here, but they're going to outlaw companies that are based in the United States to buy it. And so there's all these weird things. Why did you pick a hedge fund? Why 50 million? Like this weird thing that you just drew.
Because it's not serious. Let's be honest. It's another one of these. And that's why I hate that we're doing the same thing where there's always these bills proposed, and then all of a sudden it goes all over the internet, all over the news. Oh, new bill proposed this, new bill proposed that. It never gets passed. How many times have we seen the 1031 is going away? every year or two, all of a sudden it's like, oh, 1031's going away. And then for 2 or 3 weeks, everyone's talking about, well, this is how the housing market would be affected. This is how investors would have to shift. This is all these different things. And then it doesn't get passed. It's the same thing here. This isn't going to get passed. This is just if you look at this senator's track record, he keeps trying to be the first to do things. Like he's like one of the first ones to speak out and say, we need a ceasefire in Gaza. He's one of the first, like he's trying to make a name for himself. So he's just putting out a bill that's going to get his name all of a sudden, every single article that we read, his name's at the top that he proposed this. And so it's if we know his name, then he's all of a sudden a better politician.
Yeah, but here's the lesson though, I think, and I think AJ, I'm surprised you missed this one, but so this is just another example, right, of a governmental policy that has unintended consequences that creates another problem, and now we're trying to fix the other problem that was caused by the governmental intervention in the first place. And that is the artificially low interest rates that was going on since 2008, 2009, where these hedge funds, had they not had this opportunity, they basically borrowed money at 0%, 0.5%, took that money and bought why would you not take money at 0.5% and 1%, go invest it in real estate where you can get 6, 7, 8, 9%? That's the mother of all arbitrages.
And normal people didn't have it. They couldn't do it. They couldn't get it. And it's like, you meant, like, why are they doing it? So why did this opportunity arise? And then all of a sudden, if they're doing it, why didn't other people buy them up? And investors, frankly, saved the housing market. So that after 2008, the only people that were buying, because banks would not loan to normal, regular people, were well-backed institutions. They saved the housing market. They came out and bought up inventory at pennies on the dollar, and they gave the housing market a floor.
Well, private equity always saves uneven markets. Whenever there's an issue in the market, it eventually gets so bad that private equity steps in.
It steps in, but there's a delay problem, because what we talked about this, I don't know, probably 10 episodes ago now, where now hedge funds, it doesn't make any sense. Like, they're earning 6% on the real estate, on the commercial or the single family homes or whatever. They can just park that money in a money market fund and get the same amounts. The arbitrage isn't there anymore. And going forward, they can't borrow money at 0.5% anymore. They're borrowing money at 4 or 5%, and they're just not going to get the arbitrage. So even moving forward, I think you're just naturally going to see less of these big institutional, because they just can't borrow at the rates that we're able to borrow in 2012, 2013, 2014. But if we really had a quote unquote true free market, we would never have had 0% interest rates. We'd be always at 5 or 6%. And then the hedge funds wouldn't have been able to do what they did. They just took advantage of an artificially low interest rate environment to borrow money at 0, invest it in real estate and get 6 or whatever, 5 or whatever they were getting. Great. Now that trade's over. They're actually unwinding that. And that was one of the discussions we had about whether that was going to bring down real estate, maybe start a recession, because all the institutional players were now getting out. Because again, why would you get 6% with all this risk when I can just put it in a money market account? So anyway, I think, to me, the unintended consequences of policies just come out, and that's what happens all the time. You have an issue. It's like whack-a-mole, right? You do something else happens. You try and put a Band-Aid on that, but that causes something else, and you just constantly keep whacking all this stuff, because it's like regulation on top of regulation on top of regulation.
Well, and here's my problem is that it doesn't happen in a vacuum. Meaning this: if you help so everybody's complaining about higher housing prices, right? So the government's like, okay, well, we'll just saturate the market with inventory and housing prices will fall. So now you help out the person that can now buy that house at a really low amount, but you're screwing the person that was selling it. So this is not a game where you're like, we can help this group without affecting the exact group you're trying to help. So one person is losing for somebody else winning. You want to decrease housing prices by 30%? Do you think the person that's selling their home wants that?
Tell you a fun story, and it's kind of unrelated. I'm going off track here, but I liked it. It goes to Mauricio's.
As long as you like it, Jay, we're good with it.
That's all that matters.
Even if we lose all 7 listeners of the podcast, you go for it, buddy.
They're going to like it too. And I'm going to talk about the benefits of being a real estate investor. So this goes to your point about unintended. Wow, I've already had too much to drink. Unintended consequences. So today, my wife was filling out our Affordable Care Act form for next year. That's how we get our insurance. And they ask you how much your income is, so they can determine if you need subsidies from the government to help pay for your insurance. And so my wife said to me, what was our income last year? I said, well, let me go check our tax returns. I checked my tax returns. I went online and I looked to see how.
Wait, what was it? 2.3 million?
I went online to see what is included in income. It was negative $248,000. So I told my wife negative $248,000, but I mean, I guess that's zero.
Government's going to pay for your health insurance.
Yeah, she put it in, and basically our insurance next year is under $100 a month for a family of 4 with low deductibles. Because I was being honest. I'm not trying to get around the system, but this is the whole point of these unintended consequences. The government can't think through every edge case and every scenario, and they don't understand things. They don't understand how wealthy people make money. They don't understand how hedge funds work. They don't understand how hedge funds are going to get around these regulations.
Well, and why is Blackstone buying real estate? Because tax benefits is a major thing. So that's an idea right there. If you want to incentivize people to buy more single family homes, how about you just do it with tax benefits? You make it more beneficial for people to own homes than it is for people to invest in them.
Yeah. And at the end of the day, though, the person that's not going to get hurt in all of this is the hedge fund.
Correct.
They're not going to be hurt, everybody. So it's wild that the government is putting forth all of these laws to try to change inventory in the marketplace and skew these marketplaces when the hedge funds are they're like, whatever, we move on to something else. It literally means nothing. But then you have all these sellers, you have all these unintended consequences. Why? Because now the market doesn't work normal.
Or you would just have all of a sudden a bunch of mini investment firms that are only 45 million that are buying small chunks of each of these Blackstone funds. And where did they come from? Oh, I don't know.
And you know how you know that, by the way, AJ? You know how you know that the hedge funds aren't going to be affected? It's because this law has been introduced. Like, it's not a big deal. Like, if you introduced a bill that said, check this out. Yeah, if you introduced a bill that said, hey, if you're an institutional investor over $10 million, you are not going to be able to take advantage of the tax benefits of real estate. What do you think will happen then? Freaking lobbying money is going to come through the roof. They're going to go in there and they're going to crush whatever's going to happen, and that's not going to happen. But this one doesn't affect them, so they're like, who cares? Like, well, we got to pick our battles. This is not one we're going to fight. We'll just let it happen because we're not going to put any lobbying money against it. Or we know, or actually what's probably, it's just not going to pass. Like, again, to Kyle's point, this bill is not a law. It's just been introduced by some dude, and they just know that it's not, there's no concern of it passing, because if it,
I think though it's scary because what they're doing and how I think once again, what they're instituting, first of all, they said literally, this isn't why we have a housing problem, but we're going to pick this group and now we're going to specifically target players in the market on and say you can or you can't do
because
these
it's
things.
An easy evil. It's a faceless entity that makes boatloads of money, and that's the easiest evil thing to target is a hedge fund, because there's no one who actually has there's no person behind hedge funds, and they could just say these evil people who are making all these money, we're going to try and get them. And so it's an easy political win.
Who's going to buy? So let's let me go back. So let's go. So who's going to buy? Let's say this passes and hedge funds are no longer allowed to own these things, so they got to get rid of their 500,000, units. Who's going to buy those units? Is it going to be? Are they going to be available to mom and pops, to homeowners?
They're going to. I assume they're going to sell them on the free market. They're going to throw them on the MLS.
Doesn't that provide more inventory to homeowners and solve the housing crisis?
Actually, what they'll probably do is they'll go out to friends and family and say, hey, start a $45 million fund and I'm going to sell you a bunch of property. And they're going to do that with 100 of their closest friends and colleagues.
And even if they couldn't figure out how to do it, at the end of the day, who does it help? I mean, if it passed how they wanted, if you could actually get it, and once again, they had to put all of it on the market, who is it helping? Because guess who's going to buy it? Investors are first of all going to buy it, just ones that don't meet that criteria. So let's say it's not the hedge funds, which it is, just smaller ones or whatever it is, but all of a sudden they're doing it at a reduced price. So you're then hitting and hurting the homeowners, but you're not accomplishing anything by it at all.
Well, I think we spent enough time on it considering it's never going to pass. And so it's just going to be one of those topics that fleets in the wind and just Kaiser Soze is gone. So let's move on to to some interesting. Jay's going to take a stance here. So we've spent a lot of time on this pod discussing the state of the commercial real estate markets, and a lot of those discussions have ended with us predicting whether markets have reached their bottom or if they still have lower to go. And well, today our own Jay Scott is going to go on the record with his definitive prediction. So Jay, have we reached the commercial bottom?
I thought Mauricio was going next. I wasn't prepared. I needed I needed another 20 minutes to prepare.
He's trying to get it all ready right now. He's reading a book. He's taking notes over here.
Honestly, you caught me off guard here. I thought Mauricio was going next. Okay.
You literally wrote the notes for this and put yourself second.
It's your position.
I feel like we're in Anchorman when they ask him to do the jazz flute and he's like, "Oh, I'm so not prepared," and then pulls it out of his sleeve. Like,
pulls out his flute.
Jay Scott is literally the director of the show, basically owns the production, and is like, "Oh,
the wine is not good, but it's strong." Okay, so let's talk about commercial. And
by the way, I actually thought I was going next as well, but that's okay.
Thank you. So obviously, I can't speak to all aspects of commercial, and I really want to hear AJ's take on self-storage and your guys' take on other asset classes. But with respect to residential asset classes, meaning multifamily, large multifamily, mobile home parks, et cetera, I'm going to go on record and say I think we have substantially hit the bottom on prices. Now, this doesn't mean that there's not going to be some fire sales here and there. There'll probably be a lot of them over the next couple of years. Doesn't mean there's not going to be additional pain in the market. Just because we're at a bottom doesn't mean like everything's going to improve overnight. But I think that for stabilized assets, meaning assets that are being well run, that aren't in terrible distress right now, prices should only go up from here. And I know a lot of people disagree with that. A lot of people think a recession's coming. It's going to hit multifamily. We're going to see prices drop a lot further. But I don't think that's the case. I think we're at a bottom on values. And let me tell you why that is. So number one, and I talk about this all the time, values in commercial real estate are driven by two things. They're driven by income, and they're driven by this thing called a market cap rate, which is basically a multiplier in the market. And I would argue that both income has bottomed out at this point for the most part, and cap rates have topped out. They've gotten as high as they can, meaning the multiples have gotten as low as they're going to get. And if both of those are true, then we are, by definition of how we value commercial real estate, we're at a bottom. And so let's address each of these pretty quickly. So on the income side, we all know, anybody that's in the residential real estate world, rents have had a tough year. In some markets, we've seen rents down this year, but they appear to be recovering slowly in a lot of markets, 1% growth, 2% growth. But
I'm sorry, when you say you have a hard market, meaning it was up 20% 2 years ago and last year it was down 1%?
Yeah, but down 1%, that means your net income is lower. Couple that with higher cap rates, and you're going to see substantially lower values. And so just the fact that we're seeing a flat rents or increasing rents at this point, that's a strong sign. Now, let's be clear. Income is only one, or rents are only one part of the story. There are other things. There's occupancy. So we've had super high eviction rates. In some states, we're seeing evictions more than 50% above where they were pre-pandemic. But we're starting to see evictions starting to stabilize as well. And then the other big thing is over the last several years, we've seen tremendous expense increases. So in many states, insurance is through the roof. I mean, we invest in Texas, I own in Florida, and insurance is up 3 times for some properties. Property taxes have obviously gone up. Typically, jurisdictions don't reassess property taxes every year. And so all those gains that we saw between 2015 and 2022, a lot of them are starting to hit now. Labor and material prices, I mean, we know inflation was over 9% last year. So just maintenance and CapEx costs are through the roof. And now, while those aren't necessarily coming down at this point, they aren't going to be rising as quickly. I think we're going to settle down. Hopefully we're back down to 2 or 3% inflation for the near term. And so on the income side, I think it's fair to say that NOI last year was probably lower than it's been in several years, and probably lower than we're going to see moving forward. I think we're going to see incomes moving up from here. And then on the cap rate side, I think we've likely hit a top on interest rates. We'll know more in a couple days when the Fed meets. I don't think we're going to get a cut this month, but I don't think we're going to see any more hikes before we start seeing cuts next year. And so while cap rates are really low compared to interest rates right now, that spread between cap rates and interest rates is really small. I think people have gotten comfortable with the spread, and we're not going to see cap rates go up much more. And as cap rates go down, I think we're going to likely see interest rates, or as interest rates go down, I think we're likely going to see cap rates start to follow. And a lot of people are talking about, what if there's a recession? If there's a recession, what's going to happen? Well, if there's a recession, I think a lot of money is going to move into treasuries. If money moves into treasuries, then we're going to see treasury bond yields drop. The risk-free rate drops, and that's going to drag down cap rates with it. People are going to be happy to invest in real estate at, again, 5%, where they were a couple years ago, if they're only getting 2% from treasury bonds. So all in all, I think we're at a bottom, but I do want to put a little disclaimer on this, that I don't think we're necessarily.
You better put in a disclaimer. You better put in a disclaimer in there right now. Put it in there.
We're not out of the woods. So it could take years for values to get back to where they were a couple years ago. I'm not saying things are going to jump back up over the next year or two. It could take 2, 3, 5 years for values to get back to where they were. And there are a lot of multifamily operators who are struggling, that they aren't operating stabilized properties. And anybody that has a deal that, or a property that is facing a refinance or the end of their loan term in the next couple of years, well, they're going to have to refinance when values are down, and that's going to put a lot of pressure on them. So I do think we're going to see some fire sales. I do think we're going to see some struggle in the market, but I also think that we're probably at a low point in terms of values, and anybody that's operating a property that's in pretty good shape right now, that can sustain having to go through a refinance, or can sustain having to hold on for a couple more years, they're going to be just fine.
All right, so let me just jump in here before anybody else jumps in. I'm going to highly recommend all of our listeners go back to episode number 16. And episode 16, I think, AJ, you were out. We had an amazing guest. Brian Burke was in the house.
Yep.
And we talked about what happens when there's a recession, right? Because when there's a recession, you're like, oh, people will buy treasuries. No. When there's a recession, people are out of work. They can't pay their rents. And even though from a economic, like if you're looking at NOI and your pro forma, you're like, oh, rents didn't really go down much. They were $1,000 a month or $1,200 a month. And now maybe they're still maybe $1,150. They don't go down much. We talked about how that really is a little sugar coated because you have all the concessions, right? So maybe rents didn't go that much further down, but you had to give 1 or 2 or 3 months of free rent in order to keep the tenant. So I have a hard time agreeing with the fact that income's bottoming, the income of the property bottoming out if there is a recession. Again, we don't know if there's going to be a recession. Obviously we've talked about on the pod before what our thoughts are and more importantly, how severe that recession is. But if it's a severe recession and people start losing their jobs and people can't pay their rents and people start defaulting on the rents, you can't tell me that income is just going to be like, oh, it's going to continue as normal, even though maybe theoretically, we still get $1,200 in rent, which is what we got last year. But you're only getting 10 months of rent because you had to give 2 months of concession. So that's the main pushback I'm going to give is if there's a recession, the institutional investors will buy treasuries, but the rest of us won't be able to pay our rents because we're out of a job.
Well, you guys are talking about different levels of extremity for a recession. Like there's not just one type of recession. If you have an extreme recession, yes, we're gonna have a ton of job losses. People aren't gonna be able to pay rents. But if we have just this little mini recession that people are kind of calling for, then Jay's right. People are going to buy treasuries and everything's going to be fine. It's probably going to be somewhere in the middle there. And so then you just got to be a little bit more selective of what you are purchasing, because when you talk about who's going to not pay rents and who's going to get hit the hardest, it's usually the extremes, like the real low incomes in a typical recession. They're the ones who are going to have trouble paying rents. And then as far as price corrections, it's going to be way up at the top, as that's also going to get hurt as well. So if you kind of take that middle ground, as people say in apartments, B class moves up, moves down, then you should be fine. But it's one of those, hey, if you adhere to Mauricio thinking this is going to be a real heavy recession, yes, it's going to have issues.
Would you say 2008 was a heavy recession?
Yes.
Yeah.
Okay, well, look at the chart I just put up on the screen. And for those that are listening and not looking, this is basically rents over time. And what we saw was from 2008 to 2009 and a half or so, rents continued to climb at the same historic rate as we had seen for the previous 15 years. Between 2009 and 2011-ish, it looks like they flattened out. No doubt in some markets were hit harder than others, but on a national average, rents didn't go down in 2008.
Yeah, but to Mauricio's point though, there's occupancy, bad debt.
Let's go to simple math. Okay, let's do some simple math, Jay, because apparently the wine you're drinking has impeded your ability to do basic math. If you have rents that are $1,000 a month and you get 12 months of rent, you're getting $12,000 a year. If the following year you still get $1,000 a month in rent, but can only collect 10 months of rent because you got to give away two, you're down to $10,000 a month. So you go from $12,000 a month in rent to $10,000 of the rent, even though your pretty graph that you just put up there, for those of you who are watching on YouTube, it looks like it's flat or maybe even went up. Yeah, from a monthly rent standpoint, but from an overall over a 12-month period, if you've got to give concessions, that number's lower. And this is not me. Like, I don't know anything about anything. This is Brian Burke, our guest on episode 16, brought up this amazing point, and I agree with him.
And I'm not arguing that that's the case. We are going to see more concessions and we're going to see higher occupancy. But let's then talk about, well, how about expenses? So if we see a major recession, most likely labor and material prices are going to collapse. We saw that in 2008. Maintenance and CapEx and putting on a new roof and buying new HVAC systems and hiring contractors is basically, I'm not going to say free, but it's a whole lot cheaper than it would be 2 years ago. And what's going to happen to all those people that get hit in the recession that own their home and have to sell their home and they get foreclosed on? What are they going to do? They're going to rent. And presumably a lot of that 66% of the population that currently owns their home, if they have to sell, they're going to be in a reasonably good position where they can go and they can rent and afford to pay their rent. So we're going to have a lot more demand for rental housing as well. So I'm not saying you're wrong, but I think we can cherry pick any one or two or 10 variables here. But at the end of the day, it's pretty complicated. Maybe you're right. Maybe you're wrong. I'm going to stick with my prediction.
And I think one of the major reasons we've gone down so far, though.
I'm texting Brian Burke right now. I'm like, Brian.
I was literally just emailing with him a few minutes ago.
Brian, Jay, you got to watch this episode. Jay is calling you out.
Well, but I also think, though, one of the reasons that prices corrected so far down was just uncertainty from banks, uncertainty from underwriting, uncertainty from everything. There was just in the last year, there's just been so uncertainty of what's happening with Fed rate hikes that lending stopped. You had major institutions go pencils down. So they stopped buying entirely. It just kind of created this market with very few people able to buy.
When inflation's doubling every month, you stop doing everything because you don't know, are we going to 15% interest rates? Are we going to go it's just, yeah, I completely agree. It's that, how do you plan? How do you allocate capital? Because especially if you're allocating massive amounts of capital, if interest rates do go to 15%, right? What your money is worth sitting in a bank account there's no reason to even take risk at all. And people may say, oh, well, that wouldn't happen. We were on our way to 10 just a few months ago. So when that's happening, yeah, it freezes. The market shuts down.
Well, in banks too, right? Banks had to hedge their bets with their fixed rates. Like, they have to put out fixed rate products. They have to take into consideration the potential downside of interest rates running out. And so if you're not that Fannie or Freddie government entities, like, you have to look at your own balance sheet. And so it was really affecting them as well. And so to Jay's point right now, if the market starts to believe that, hey, like, we're done with the rate hikes. We might not be cutting right now, but at least we're done with the rate hikes. That takes that whole downside off the table of this having runaway interest rates. And then all of a sudden the market starts to normalize a little bit. And that even if we do have some of these other risks of recessions and things like that, at least we have a normal market to work with the normal players in it. And that's going to naturally bring prices back up.
it may help. And a lot of people look at the market and they're like, I don't understand. That was bad news. Why did the market rally? And they're like, because bad news meant that there's an opportunity for the Fed to stop raising interest rates and that's what they care about. So even though I think there are bumps in the road moving forward, let me be clear. I do not think it's going to be rosy. That doesn't mean that that's bad for assets. And I know that's a hard thing a lot of times to conceptualize, where it's like, how in the world is people losing their job good for assets? Because what hurts assets is high interest rates, way more than unemployment at 3 versus 6%.
And let's be clear. I mean, I was playing devil's advocate when Mauricio was saying that income is going to go down if there's a major recession. You're absolutely right. If there is a 2008 type event, if there's a 1929 type depression, yes, we are going to see most likely asset values continue to fall. My point is, I don't think that's likely to happen. And in what I consider to be a likely case, which is we're going to see a recession. It's going to be a minor recession. It's going to be a typical recession. We're going to get past it in a year or two. In that case, I think we're at the bottom, and I'm comfortable predicting.
I love the fact that I just have to throw out Brian Burke's name out there, and Jay backs off a little bit. That's awesome.
You could see him shift in his chair.
If you ever want to make an argument that I'll buy into, just tell me Brian Burke said it first, and I'll probably buy into it.
Love you, Brian. We love you.
I want to go over to AJ for a second. So I talked about multifamily. Tell us where we are with self-storage right now.
Yeah, self-storage, there's so much interest from people wanting to place capital. It's crazy, but their spread on the bid ask has been nuts. We still have developments going on in self-storage, even though inventory has gone low, but the rates are the driving factor, I believe, in valuations, because the rates have changed so dramatically over the last year. Getting banks, everybody else to underwrite, it's not a pretty thing. But self-storage is extraordinarily seasonal. So the busy season and the slow season, rates go up and down dramatically. We are in the slow season. And I believe that this slow season is the bottom of our rate cycle. So the contraction through rates we are seeing in the last 3 months, revenue on all our properties is rising. Now, there's reasons for that, but I think even stabilized properties that had huge contractions over the last year and a half, this year it's a much more stabilized slow season, where last year it was a free fall. Rates, they didn't have a bottom. When I say rates, everyone, excuse me, I mean rents. Rents didn't have a bottom. We had markets where some of the units were going down 60%. So that is, obviously a destroyer of any kind of planning, anything else like that. Now, with that said, though, we've seen basically this, we haven't seen that. There's not been that at all. We're raising rents and rates on all of our assets, and they're all up in revenue. And I think the slow season's the bottom from rents. Now, the demand of capital trying to get into this asset, I think if they just even get close, we're going to see cap rates drop fast, really fast, because the amount of money trying to get in, that bid-ask spread's getting closer and closer. So I 100% think this is the bottom.
But there are some markets, though, that it's going to take them a while to really bounce back in self-storage, because like we had, as far as rents and apartments, yes, we had a bit of a down season, but we're talking like rents went negative by like 1%, 2%. Like you're seeing self-storage. I think I was watching the Green Street summary of commercial markets, and they were saying like on average self-storage went down 16%. So like when you want to think about like even just to get back to where they were normal, like you got to see rent increases of almost 20% just to get back to normal from before. So like it's going to be a while.
Our average is 30. So we give rent increases of 30, 60% all the time in storage. That's normal. That's actually common. We'll discount 40% and then they'll give them an 80% increase within the first 3 months. So even the storage companies that posted a 20% reduction, they all made more money. They were all positive, even though they were dropping rates by tremendous amount. And that's the benefit of storage and why people like it, is we can drop rates and then get somebody in and you can double their rate and they don't move. So it's an offset to it, and our rates fluctuate massively. So we can do one busy season to the other. Rates are just like all over the place. And so I don't think that's as big of a deal as in other asset classes. Obviously, that can't really happen in multifamily. But I do agree it will take a few years to get back to where we were. There's no doubt about that. Where we're seeing consistent rate increases, where we're seeing street rates return. So the growth on storage is dominated by the revenue management and pricing in the back end, not the front end right now. And I do believe we have another year or two until it returns, until it returns to the front end, meaning we're actually lifting up and being competitive on street rates.
I know you were inversely, I mean, this is an interesting point, and this is why it's awesome to have, one of the foremost experts in self-storage, but are you inversely correlated? Meaning when there's a recession, like in my mind, when there's a recession, I just went through the argument, there's a recession, people lose their jobs, multifamily, the rents, either they go down in absolute terms or you got to give concessions. But on the self-storage side, recessions, is that typically good for you guys? Because people are forced to, I mean, it's not a good thing in the economy, but people are forced to sell their homes and they're like, crap, I got to go put my crap somewhere. Let me go put it in one of AJ's storage facilities.
Yeah, change is good for storage. That's why what happened, and I was really worried about it, because everybody was like, interest rates are rising, but it's okay because even in recessions, storage does good. And I'm like, well, it's not recessions, it's change. And what happened was the high interest rates froze the housing market. So it was the opposite of what we wanted to see. There was no change. Everybody stopped. They stopped moving. And so that is a killer to storage, right? Whereas we would have been better off if we went into a recession and people were moving around and changing because of job loss, things like that. That would have been better for storage than what happened.
Yeah, I saw a graph that had the two of those with like the number of housing transactions versus the self-storage, and it's literally like on top of each other.
Can I just say that I mean, I've been in this business for 16 years and I've been following self-storage, and the conventional wisdom is always that recessions are good for self-storage. And anybody that's listening to this podcast, that's the reason to listen to this podcast. Like, to hear somebody say what moves self-storage and it be not different than, but something I've never even thought of. And it's so obvious when you say it, that like 16 years in this business and I've never heard that before. And it just changes my way of thinking about that entire asset class. So yeah, this is why I love doing this podcast with you guys.
So I guess Jay sits in on webinars and only listens to the multifamily section. And when they start talking about self-storage and office, he just shuts it off and goes to the next one.
Did you know that?
Yeah, I did. I literally just said, the Green Street last week had their property sector reports, and I watched the whole thing, and they put up a graph, and it had the number of housing transactions per year, and then it mirrored it with the self-storage and what the rental rates were, and the graphs were on top of each other.
So you learned it last week.
No,
yeah, last week. That is not something that was common knowledge or accepted prior. So before then, they actually didn't think self-storage was correlated to hardly anything. A lot of people thought it was literally recession proof. And the reason they thought it was that because of tight markets, storage hadn't been overbuilt. And so there was no reason to, meaning that whether it was tight or not, we still had occupants. Yeah, we may have moved, but just because you had a city that didn't have housing transactions didn't mean self-storage was hurt. But what happened was in the last 5 years, we had so much supply go onto the market that if you weren't getting the new customers in, you couldn't maintain. And so that's why this is the first time that's ever happened. I mean, during 2008, we had occupancies that dropped by around 20%, but our rates only went down by 8%. That's it, 8%. We had 3 months ago, it was up to 30% across the board in the United States rate drop. So this is brand new and really what it's seen, and it should, and it hopefully has changed a lot of people's mind and understanding about self-storage and how the economics of it works, because a lot of people just thought this is easy, hands off, and it just does good. Like you just buy them and they just do good. And that's
Well, it makes sense to me
absolutely
then too that low interest rates, self-storage would be one of the best beneficiaries of that, because people are more willing to buy and people are more willing to sell when there's low interest rates because they're not worried about giving up their mortgages.
That's why the COVID bubble happened. Like storage blew up during COVID. It was shocking because interest rates got so low and we had 96% occupancy. We had 3 years of 96% occupancy, where prior to that, we'd never hit 90% occupancy ever.
So let me wrap this segment up, if that's okay, Kyle, with a question for AJ. For those smaller mom and pop self-storage investors, I know 6 months ago you were saying not the right time to be entering the market. Is now the right time to be entering the market for those investors?
I think now is a great time to be getting into storage, only if the market has okay demand and is not getting new supply. So self-storage is so sensitive to demand right now. If you're buying in a market and a new storage facility opens up, that is going to be very difficult situation in that very localized market, because you're not going to just fill up. But the prices, cap rate spreads, especially in third, fourth tier markets, I mean, you're talking about a 300 basis point spread in a lot of small markets for storage. And so you can get good deals. And as long as the supply hasn't dramatically and is not going to dramatically change, so you can see a good trailing 12, I think it's an excellent time to buy.
Well, and if you read the headlines, self-storage is down 21% from its peak. Apartments are down 30% from their peak. So at the end of the day, if you believe real estate is going to come back up eventually, then it can't be that bad of a time to be buying. All right. Should we move on and get some free legal opinions, shall we? So let's talk about customizable funds. It seems like every week there's a new investment vehicle that's supposed to make things better, cheaper, and easier to do syndications. And the current darling of this trend is customizable funds. The pitch with customizable funds is they allow sponsors to set up just one fund for multiple investments, and investors can pick and choose which investments they want to be involved in. Essentially, you get all of the benefits of a fund with none of the drawbacks of having to blindly trust some sponsor to pick your deals for you. So it sounds a little bit too good to be true. So I'm feeling like it might be. So Mauricio, why don't you tell us how this just isn't the golden goose that everyone thinks it is?
And maybe do a better job of explaining it first.
Yeah. So first of all, I hate them. I hate them, and I'm glad. And I gotta give a
Kyle or fund or the customizable funds.
Both. So look, I really did try, and Bethany, my partner, and I really did try. But at the end of the day, and I think the straw that broke the camel's back, actually, Jay, you brought this point up, and it was, you came up with some issues, and I'm like, it just doesn't work. Like, and here's why. Here's what a customizable fund, in theory, it does. And not that in theory it does, it actually does, which is, if you're a sponsor, it allows you to create a fund, in theory, right? You create a fund as sort of your first layer, your master fund. You put that together. And then you allow investors, instead of investing in the whole fund where you have 10 or 20 or 5 different assets, they invest in all of them. You say, look, you get the choice to invest in asset number 1 or asset number 2. Let's just say you have 5 assets in the fund. Instead of having to invest in all of them, limited partner, you get to invest in either number 1, number 3, or number 5. You get to pick which asset you get to invest in. That's why it's called a customizable fund, because it's customizable for the LP, that they get to choose what asset they get to invest in, right? And it's really billed as this amazing thing. And at the end of the day, and I struggled with this, because at the end of the day, it's not great for LPs, it's great for sponsors, right? And as somebody who represents sponsors, I'm like, hey, I've got an obligation to my sponsor clients to help them, right? And so if it's good for the sponsor, who cares about the LP? Like, I don't represent the LPs, whatever. But at the end of the day, our clients, and there's a lot of them in this room, we represent clients who don't want to get sued by LPs, right? And I think some of the issues with these customizable funds, and number one, it creates a huge amount of confusion. It's super complicated. Everybody wants to say, oh, it's easier, it's simpler, it's faster, it's cheaper. The reality is it's more complicated. It's, if you do it right, it's maybe even more expensive. And you've got to, by the way, I see Kyle's hat going all over the place. It's a little distracting, Kyle, but your hat's going sideways and whatever. That means we've gotten to that point.
I didn't realize you stared at me while you were talking. I'll
Dude, I got peripheral. I'm trying to address the pod here over here. But anyway, so here's the issue is that there's the reason and this is a new position, honestly. Like we were doing some for clients. We've only done it actually twice for clients, to be honest with you. And both times it's been a little bit of a disaster because number one, even though we explain it to the syndicator then tries to explain it to the LPs. It's a disaster. And the LPs don't really understand what they're getting into. And at the end of the day, and this is what was my thought from day one, is the LPs don't get any benefit from this, really, because number one, the LP is way better off to just go look at, well, if you have 5 different assets, I'm better off you just doing 5 different syndications than me going to pick, I'll go into syndication number 3 or I'll go into syndication number 1. That's my option. It's either I do a customizable fund or you come to me with 5 different deals and I just get to pick and choose what deal I want to get into, like more of a project specific. And here's the reason why it's not great for LPs. And initially it's just a disclosure issue for us. So as long as we disclose this, we're good, but LPs still don't get it. And that is, even though you get to pick what asset as an LP you get to invest in, you're still part of that master fund. There's still just one master fund that I'm a member of, along with a bunch of other people who are invested in different funds. So if something were to happen to one of those other assets, so think about a real estate fund where you have 5 different properties. If something were to happen to property number 5, even though I'm only invested in property number 2, because we're all part of the same deal, whatever liabilities happen over there, the fund is responsible. So if the fund's responsible, I'm responsible. So now suddenly I've got all of this additional risk as an LP.
When you're saying risk, are you saying like legal risk? Or are you saying just like losing your money risk?
We're talking all of it. So there's risk of number one.
But they're LPs, so they should have limited liability anyway, right?
Sure, but I could lose my money. So if you put $100,000 into a deal, right? So you invest in asset number 2. I love it. Jay's asset number 2 is amazing. It's in Florida. It's sunny. It's on the beach. I love it. Jay, I want to go with number 2. And Jay doesn't do customizable funds, but hypothetically, right? And then somebody else, Jay also has another deal in Detroit, right? Or some other place that whatever. And then that property in Detroit has some issues. It's got nothing to do with my asset. I'm in Florida, sunny Florida, on the beach, great location, great market. Rents are doing great. My deal is going phenomenal. My returns are fantastic on my deal. Everything's super great over here. But the other fund, somehow Jay decided to put Detroit or whatever other asset over there. And there's a problem over there. And the problems could be there was a slip and fall on the property. And so the owner is getting sued, which means the fund is getting sued, which, by the way, I'm a part of that too. Or maybe the lender, for example, right, when you got a loan on that other property and the lender wants to put a lien on it as a personal guarantee for the fund, something goes wrong in that other property. It suddenly affects me. Even though I don't get any benefit from that fund, as an LP, I'm affected. So I get no benefit from that property in Detroit or whatever. I'm in sunny Florida. I have another asset that I'm not even a part of. I get no benefit, no profit, no loss, no nothing. There's an issue there. It affects the fund. And now it suddenly affects me. So there's an additional risk involved. If there's a lawsuit against the fund and there's a multi-million-dollar lawsuit and the fund has to go pay out a bunch of money, guess where that's coming from? My distributions, because now there's not enough money in the fund to pay my distribution. There's a huge issue over there on that property, and the lender calls the loan. It just failed. That property failed, and the lender comes in and say, "Hey, you're not performing. I'm calling the loan. There's a deficiency. You owe me $5 million. The fund is going to have to owe that $5 million. I'm a member of that fund."
I don't know. I just think you're being a lawyer right now, because I don't like all of these things that you're bringing up. Like, I think proper structures prevent any crossover. Like, if you're buying one property, like, you're going to have an entity that buys that property, then the fund's going to own the entity. And yes, technically everybody who picked that entity in Detroit, they're the ones who are going to lose all their money. And the people who picked entity 2 aren't going to lose their money. And technically, like, if you're buying these properties and with non-recourse loans, like, even if the property does get foreclosed on, you can only lose the money that you've put in. They're not going to come back at you because it's a non-recourse loan. At the end of the day too,
you guys are putting me in a really tough position here. I have to decide from a legal perspective who to trust. Do I trust the guy that went to law school that I pay lots and lots of money to be my securities attorney? Or do I trust the guy that can't wear his hat forward or backwards and is drunk off of that?
But you have to admit though that lawyers, it's the same thing with, lawyers are always going to say that the issue is you need to lawyer more, and insurance people are going to say you need more insurance, and like that's what they've learned. They know but then there's real world situations, and it's always just more pros and cons than black and white.
Let me give you the real world. Let me give you the real world. Okay, let me give you the real world situation. This is like one of 5 things I have, so this is just one of the issues. But again, Jay has a fund, right? Kyle, you decide to invest in the Detroit project, right? I decide to invest in the California project. Right? All good, right?
Both bad investments, Detroit and California.
I would not invest in California. Let's be clear.
Understand? You put $100,000 into the deal in let's say it's a Florida deal. You put $100,000 into a deal in Florida. I put $100,000 in the deal in California, right? My deal blows up, right? My deal, I lose all of my money. I put in $100,000 in the California property blows up, cap rates, whatever the issue is, right? Right? I've lost all my money. Who am I suing?
The fund.
I'm going to sue the fund and the sponsors and everybody involved for $10 million. Now, number one, you've got to pay legal fees, right? Where do you think that money's coming from, those legal fees? Where do you think it's coming from?
The fund.
The fund, right? If I get a judgment we put $5 million into this deal in California. I lost all my money. I sued. I won. I got a $5 million judgment. Who's paying that judgment?
The fund.
And then the fund pays that $5 million. Where are they going to get the money to pay your distributions, buddy? Kyle, you're over there in Florida. Your deal's doing great. Your deal's got full 90% occupancy. Your deal's going fantastic, buddy. You should be getting a 10% return, 50% return. But you know what? There's no money in the fund. Why? Because I got to pay the judgment over here in California. That's the issue.
No offense, Mauricio, but I'm gonna hire Kyle for our next deal because I think he seems like he's much more confident of keeping me out of trouble.
You should. What happens when some guy comes on the California property and shoots the tenant, and that guy sues for $10 million and wins? Who's going to pay that judgment?
Just that's a property specific. That was my point. It's going to be segmented. That happens to that property. It's only going to affect that property. That property has insurance. That property has as a separate entity that the fund owns. That's going to be protected. I get the one. I get the one that you said. Okay, if the fund gets sued in its entirety, sure. Okay, so what you're saying is basically you're increasing your chances of a fund getting sued by having multiple properties in it. I get it. But if you want to talk about any property specific issues, I just don't see any property specific issues realistically moving across a fund and affecting other people.
So you've never heard of something called the piercing the corporate veil, meaning somebody gets sued in a property and they decide to actually pierce the corporate veil and go into the ultimate owner. That's never happened.
I should be concerned if you're bringing that up as an issue because you're my lawyer and you're supposed to protect me so that my corporate veil could never get pierced.
So my point to you, Kyle, is like, would you rather invest in a customizable fund where you're involved with Jay, you're in Jay's deal, you're involved with me and your fund, or would you just rather have Jay have 2 separate syndications, one in California, one in Florida, that you have no additional risk with mine?
I mean, if you have those options though, if you have the options and you have the time to go and search out all these different investment options and do all this stuff, sure. But we're talking about LPs that sometimes, hey, Jay's got a customizable fund. I trust Jay. Jay does a good job of what he does. And he's got this product where I can go in and I can diversify myself by investing in a bunch of different funds. And I actually have the choice. If I want to invest in a normal fund, you basically have to give your money to Jay and say, hey, Jay, please do a good job picking all these different investments. Because I'm going to have no effect over which ones you pick. In this case, I could say, hey, I like 4 of the 5 of these. I really don't like this 5th one. I just want to pick these 4. So like there is appeal to that.
100%. But you're incurring the whatever, even if it's marginal, even if in your mind it's very small increased risk, that's an additional risk that you're bringing on without any benefit.
Right, but at the end of the day, they're LPs, and LPs, their limited risk is to just losing their money. So at the end of the day, it's a cost benefit. It's a cost benefit equation. So you have to say you have to look at it. Let me finish my point. You have to look at it and say, okay, yes, there's a slightly higher risk that if somebody comes back from a different deal and sues the fund, I can lose more money that way. I have to weigh the cost of that or the risk of that with saying, hey, my time is worth this much. I can get this much benefit from investing in four different deals at once, and I don't have to do due diligence on all these different deals and have to keep an eye on all these different things. Jay's got it for me. So it's a cost benefit thing. It's not just black and white say, hey, there's too much risk and liability.
Perfect. It's a cost benefit. So on option A, you invest 100 grand and you get $10,000 every year, and over the next 5 years, you're going to make 50 grand in interest. So when you get your money back, you're going to get 150 grand in that investment versus the fund, even though the property is just exactly the same, performed exactly the same, you're going to get zero. You can actually lose $100,000 because Jay's deal over there, or the lender calls the notes. Like the California property that I have, we lost all of the value, came down. The lender came in, freaking took over just like they are now, and the lender lost $2 million. Now they're going to go after the fund for that $2 million.
No, they're not. If you get a non-recourse loan, by definition, their only recourse is the property. They can't go after the fund.
So there's no bad boy car. It's never ever happened in every history.
Of course, there's bad boy carve out, but then now we're getting in. You're taking it from likelihood of something happening is all of a sudden 1%, and now you're just getting into the 0.1s and 0.001% things of happening, and then that's what I'm saying. Cost benefit ratio.
Jay, you can talk about the odds of somebody, in terms of a loss from a lender. If the lender's going to actually, first of all, you've got to assume it's a non-recourse. What if it's a recourse? But even if it's a non-recourse, what are the odds of a bank coming over these days, mismanagement or whatever? But whatever that risk is, you just got to make a business decision. That's an additional risk that you're taking on without any additional benefit, right? There's zero benefit.
All of these risks are the same, if not more, if you just invest in a normal fund. Because everything you're saying is the same, that if one property gets sued, it affects the rest of the fund.
No, we're not arguing that.
Yeah, we're not arguing that. The alternative is Jay does two syndications, one for the Florida property, one for the California property. I, as an LP, are better off in that scenario where I get to choose, hey, I'd like to do this Florida deal. No, I'd rather do the California deal. I'm in a better position there because I get the benefits of the California deal and have zero exposure, 100% zero exposure to the Florida deal if he does two syndications versus doing 5 syndications into one. I am now suddenly exposed to the other 4, or some people are doing 10. So now I've got 9 other properties that I've got to dodge the bullet on, and I have no benefit from those 9 properties. But if something were to happen in those 9 properties, I'm going to be negatively affected. I'd much rather have.
I mean, yeah, if you're looking at an ideal situation where all of a sudden Jay's closing on 5 properties all at the same time, so I got to shift my funds around one time to come up with $500,000 to invest in 5 different properties, that's great. But like a customizable fund, correct me if I'm wrong, like if I have $100,000, a lot of these customizable funds, I could put $100,000 chunk and I could divide it up against in all these different options, and versus something like Jay's 5 different funds. He's got
no, not necessarily, because they all have their minimums. So your minimums might be $100,000 for deal. So you don't necessarily get to split 25 grand of each.
Right, but at the same time, I could also invest at one time, and I can pick and choose all these different things. If we're doing individual syndications, there are going to be all different closings at all different times. They're going to like. It's not cut and dry. You can't just say, okay, for 100%, it's better just to do a simple syndication for 5 different properties than doing a customizable fund. I realize most people, what you're trying to say is most people aren't considering all the downsides and the risks of a customizable fund, but it doesn't mean that it's useless. That's what I'm saying.
No, I'm not. No. So somebody like yourself, as you're describing this, if you are aware of all of the risk reward ratio and you're comfortable with the risk that you're absorbing the risk of all these other 8, 9 properties, and you're comfortable with that risk because you trust Jay so much that, hey, I don't think anything's going to happen to these other 8 properties, that I'm comfortable doing that, then knock yourself out. But most LPs are not looking at, well, I just want to invest with Jay. They're like, hey, I can either invest with Jay, or I can invest with AJ, or I can invest with Kyle. And if Kyle's got individual, and I don't have that risk exposure, but Jay has that. But if you're aware of the risk and you're good with it, that's good. Let me go into a couple real quick other points, because I think these are important too. This is from a sponsor standpoint. So that's the LP issue, right? From a sponsor standpoint, you're not taking any non-accredited investors. That's something that one of our clients ended up not realizing that. But when you have non-accredited investors and you have a fund, and this applies to a fund. So even like, Jay, we're doing, both of you guys, we're doing a fund, a blind fund, right, to go out. And it's only accredited, so it doesn't apply to you. But if you just suddenly decided to accept non-accredited investors into your fund, you're going to have an audited financial requirement. 506B requires you to give non-accredited investors audited financials. So if you have an ongoing fund, whether it's a blind fund or a customizable fund, whatever, you're going to have to give them audited financials to the non-accredited investors, which nobody wants to do. That's a deal killer. So just realize that you're basically going to be limited to accredited investors only. And the main thing I want to point out, and this is why the cost is lower, is that these customizable funds generally push the compliance to the individual. It ends up being sort of a do-it-yourself model, because you're paying an attorney to do the main fund, but when you add an additional asset to the fund, there's no lawyer making sure that the proper disclosures are made for that particular asset. And remember, the disclosure requirements are due at the point of sale. So when the new investor comes into your fund, that's the point where you have to give them the full disclosure documents at that point. And so every time you have a new asset into your fund, you say, oh, now I've got asset number 5. Kyle, I want to sell you asset number 5. You love it. Great. I've got to give you the full disclosures on that asset. So I've got to figure out, what are the risks? What are the risks of that asset? What are the risks of that market? What are the risks of the lending product? What are all the risks associated with that specific asset? And the way most of the deals that I've seen structured, they just put that on Kyle, the sponsor. Like, hey, Jay, you figure out what the legal risks are of this particular property. And because Jay has to do it, the cost is zero. The cost is literally zero. So when we've done it, we've actually charged. We actually obviously do the disclosures and the due diligence on that particular new asset that's coming in. So we actually charge for that. So that's what blows up the cost a little bit more. But the ones that I've seen, they're just like, oh, you just do it yourself. Here's a template. Just put in the splits. Just put in this. Just put in that. And I'm like, who's looking out to figuring out what the legal disclosures are on that particular asset? And the answer is nobody. The main attorney generally says, hey, hire us to do those. But the reality is they don't.
Isn't that the same for any open-ended fund, though?
Say that again?
Isn't that the same for like any open-ended fund, though, basically, with properties coming in and investors coming in?
No, I mean, you guys, clearly you're not involved. So Jay, I could talk to you. Like Jay, like we're doing the open-ended fund for you guys. There's no ongoing. Every time you have a new asset, we got to do an amended PPM and amended this or amended that. It's like,
correct me if I'm wrong. Did I not just get something from Bethany from the new asset that we added in the fund that we needed a amended thing? Jay, did that just not happen?
We need an addendum just to basically talk about the
clearly involved, Mauricio.
You'll get all the business plan addendums, but there's no addendum to the PPM saying, oh, here are all the risks of this new asset, and you get to decide whether you are good with that. Because when you do a blind fund, you're investing into the concept, the fund criteria. You're not actually investing. You're not commenting on this particular asset. You're commenting on the fund as a whole. So yes, you want to update them on, hey.
I'm feeling a little bit hosed here, Jay, that Mauricio's company just told us that we needed an addendum to our business plan, and then he was just saying that.
Yes, you need an addendum to the business plan to show, hey, I've got a new asset. So the new investor comes in, hey, these are the 3 other assets we've done. Here's all of our reports that we've given. Here are all the financial we've already given to our investor. But we don't have to do an amended PPM and say, hey, here's a new asset we're doing. Here are the risks and disclosure of this particular asset. And before you invest in this deal, we want you to look at this. Here are all the risks of this particular asset.
I'm starting to feel like Kyle's on the take here. Are you getting money from the customizable fund lobby?
No, I feel like most people shit on it, and like it's one of those things where like people use these arguments that like they're the same arguments for other products that are already out there. Like a lot of these arguments, like you have those downsides for a normal fund or a normal open-ended fund, and you have. Yes, there's some other nuances and stuff, but like to me, it's not a lot of new things and new issues. And I don't know. I guess I'm just trying to get to the root of it, because we do,
But in those blind, but the main difference is when you do a fund as a whole, right? Let's say Jay, now you guys, you have a fund that has 10 assets in it, right? I get the benefits of all 10 funds. Like I get the profit and loss. If all 10 funds do really great, I get the benefit of that. With a customizable fund, I don't. I don't get the benefits of all those other assets. I just get the risks. So I get all the risk of those assets, but no benefits. That's the difference.
Fair enough.
Kyle, I feel like you picked a weird hill to die on this one.
It's I'm just saying, at the end of the day, like, it's not like it was coming off as very doom and gloom. Like, this is a cut and dry no. And to me, like, yes, there's always risks, but it's one thing if we're talking about legal risks where you could get sued individually and they could come after all your assets and stuff. By definition, as an LP, what you're going to lose is your money. That's it. So
yeah, but you're not going to gain much. That's the problem. There's additional risk with no gain.
At the end of the day, everything to me is a risk analysis benefit. And to me, if the benefits of being able to pick and choose in a single fund from one operator which assets I'm going to versus the extra risk that, what's the likelihood of those scenarios that Mauricio is going through, if those benefits of being able to do it outweigh the small increase in liability of losing my money, it's just losing my money, it's not me getting sued individually, then that's a risk analysis that someone has to do.
Losing the profits you otherwise would have gotten, right? If you're getting a 20% return, you're losing that 20% return. Look, if you understand that, but what we've found out is that the LPs are confused as hell. They don't understand what's going on. They don't understand that they're invested in all these different assets and they actually have risks associated with those assets. They just think they're investing in this asset and that's all good.
The marquee scenario that we used for all this was people investing with Jay, and he's a perfect sponsor, and he's gonna do a great job. So
that's why it's a bad example. So I got to admit, Jay is like one of the top. You guys are top, right? So it's different. But I know
you can only move as slow as your slowest walker, I guess, is the thing. All right, AJ, any comments on it, or can we move on here?
I don't argue with my attorneys. That's not good business.
I like that take.
So,
well, you're never going to grow, AJ, if you don't argue.
I argue, just not with my attorney.
Hey, AJ, what if your attorney were a Democrat?
Ooh,
I'm fine with that. Maybe.
Would you argue with him?
Not on funds.
Right before this podcast started, AJ was like, "Hey, we got to do more of that. People being combative and having differing opinions and we get one combative episode, and AJ just sits there with a stone look on his face and doesn't say a single thing the entire time."
I've been jumping in here, just not on this subject because I don't got a dog in this fight.
Now, this is the only subject where it got heated.
I think we should put Kyle in one of these customizable funds. I think we should force him to put in $50K into one of these.
Oh, I don't want to do it. I don't want to do it. I'll argue one side of it, but it doesn't mean I'm going to do it. I have the know-it-all and the wherewithal to be able to invest in individual funds with different people and do due diligence and all that stuff. That's what I do for a living. Like, I'm not going to do it. But.
No need for me and Jay to make counterpoints here. You had it. You got it.
So wait, Kyle, when it's time to put your money where your mouth is, you're wait a minute. I don't want to do this. Screw this. I don't want that risk. I don't want the risk.
Jay tiptoed into it and quickly backed out.
I was arguing the hypothetical LP who's a doctor who doesn't have time and loves Jay as a sponsor, and Jay's offering a customizable fund. I was arguing that point.
You know what? I know we got to move on, but that's an awesome point. Like at the end of the day, everybody talks about, the property, the market, the team, this. At the end of the day, it's like, do you trust the sponsors putting this together? And that's where all of your due diligence needs to really be focused on. Like, is this person somebody you trust? That can they pull off the business plan? And I think people, as an LP investor myself, you invest in people and operators that like and trust, that can pull it off. And the details are the details. So that's a great point. Like if Jay's amazing. His partners are not so great, but like Jay himself is great. And so if you want to invest with Jay and he has a customizable fund, you just like, look, I know there's some risks, but I trust Jay. But if you're like, hey, I can
To be clear, my main partner is fantastic. Ashley is awesome. It's those hanger-ons that
I
we have
think the
to be worried
hanger-ons
about.
don't really have any decision power. They just beat their chest, and nothing actually gets done. All right, let's finish this off, since I got to make sure I do a really good job of a top 10 here for Mauricio, because I know he loves it.
make sure this top 10 doesn't end up in next week's top 10 as one of the worst top 10s of the drunk real estate.
No, this is going to be a real quick one. It's actually because I couldn't even find 10 to put on the list, and it was this is just the top 5 private equity REIT largest home buyers of single family homes. So number 1, anyone want to guess who number 1 is?
Blackstone.
AJ.
No, it's well, I could just flip to my notes here real quick. Or we can just say it. I have it right here. I was looking at it. Crazy how many homes they own.
82,000. So the company is called Invitation Homes, but they are owned by Blackstone.
Oh, I didn't know that. So I knew Invitation Homes was the largest. I didn't know they were owned by Blackstone.
I didn't know that either. Huh.
Blackstone, by the way, you know this. Blackstone owns everything.
Everything.
I'm going to get to that at the end too. So then the net number 2 is actually right behind them. They've caught up, is Progress Residential. They're a private equity firm, and they own 80,000. So they're sneaking up there. And then there's American Homes for Rent with 57,000. And then there's First Key Homes with 42,000. You might have heard of the private equity fund Cerberus. Cerberus owns them. And then there's Tricon Residential owns 30,000. Funny thing about Tricon Residential, I think it was last year, Blackstone invested in Tricon Residential. So they don't own them, but they invested in them. Yeah. And then you might have also heard of this Front Yard, because they got a lot of press the last couple of years. Well, they were bought by Progress Residential, who is now the number 2. So that's why Progress Residential is up there close to.
And they're owned by Blackstone?
No, they're the one right behind Blackstone. So yeah, so the highest couple are 80,000, but then it drops off pretty quickly to number 5 is down at 30,000, which is still a significant amount of single family homes. But
it should be said too, with these single family homes and stuff, it's only through technology that they've been able to do this. So after 2008, their platforms they use and everything else that allows them to mass up these homes. It's really actually interesting stuff. Everybody should look at.
So yeah, AJ must have been, while he was going through his notes trying to find the name of Invitation Homes, he must have seen a line item there that he forgot to bring up. So he snuck it in on the back end. Well done on that.
I didn't, but I should have done more.
All right, let's finish it off with a drinking game. This one's dedicated to Ashley Kerr because she said we needed to bring this up on the podcast. Would you rather? So would you rather get bounced from the fantasy football playoffs in the final quarter of the last game, be out of the playoffs 2 weeks before the end, or not join fantasy football even though you were repeatedly asked to, said you would join, but then you had to be replaced by a girl that had never played fantasy before and ended up in 3rd place?
That one. Not sure who was directed at.
Yeah, well, because that is you. That's what happened. You said you would join fantasy football, AJ. Then you just never got around to signing up. I had to frantically find someone at the last minute to fill in for you. And she's never played before and ended up in 3rd place.
I just don't want to be the guy that gets knocked out of the playoffs in the last 1 minute of the last game.
Oh my God. Like I got to tell the story real quick, because Jay went into the final game of the entire regular season ahead, was in the playoffs, and he had one guy in the one team, she had one guy in the other team, and it was literally the 4th quarter. All of a sudden, Tennessee turned the ball over twice. Her guy went for 2 touchdowns, and Jay ended up losing by 4 points out of the playoffs
in like 30 seconds.
Yeah.
And I'm obviously the example of being out of the playoffs in 2 weeks ago. I even lost to the guy who was like 0-8. Like, who was like a computer at that point. Like, like I'm like.
So that was this last week. He's talking about James Daynard. James Daynard was 0-13 going into the final week. He hadn't won a single game, to the point where I had to turn the computer on to take care of his roster for him because he just stopped playing. And Mauricio was like, you know what? I want to be nice. I want to make sure that James gets one win out of this season. So he let James win the final game of the season.
Dude, that week is like his like projections double. Like some dude like came off the bench who was like, you know, on drugs and had like an amputee leg. He like scored 10 touchdowns. It was like 1 in a million. So I suck. Like I started 0-5 and then I went 5-0 and now I'm 0-5.
I know our audience is bored because I'm bored.
Yeah, you're only bored because you're the one who missed the playoffs. Everybody else is loving your misery.
I've got something to plug, and I want to plug it. So let's get to the plugs.
All right, go to your plugs there, Mauricio.
Well, I've been pissed off at Kyle always plugging his wife, and it sounds like a lot of fun. So I am going to plug my wife this week. If you guys, Nutcracker Dreams by my beautiful wife Heidi Raoul. Those are my 2 beautiful daughters. She actually wrote this amazing book. She's written a bunch of them actually with our daughters as the main characters. And so I'm going to give away a prize. I didn't think of what the prize is going to be, but if you like, subscribe to this channel, leave a comment on this episode, go buy the book Nutcracker Dreams, which I'm going to drop the link there. I'm going to enter you into a contest to win something big. And I mean big. And whoever does it first will get more points than whoever comes second, third, fourth, fifth. It's going to be amazing. Nutcracker Dreams, Heidi Raoul. It's a take on the Nutcracker. Kyle, I got to give your daughters a free copy, an autographed copy, but the winner will definitely get an autographed copy. But Kyle, I'm going to send you because you got beautiful daughters, and I'm going to send them the Nutcracker Dreams for Christmas.
And my daughter Dylan appreciates you following her on Instagram with her singing.
I felt a little bit weird about that. Like I'm like, is it okay for a 51-year-old to be following a 7-year-old?
8-year-old, yeah.
8-year-old. That seemed a little weird to me, but you know, let's do it.
The book's been out for over a year. Why is this the first I'm hearing about this?
Dude, last year it did really well. It just happens during Christmas, right? Like who buys a Nutcracker book non-Christmas? So, you know, so we're going to promote it this year. And it's a pretty awesome, it's a great story. Next week, I'll tell you about the storyline, but it's pretty cool.
You're in good company. I just looked up celebrities that have written children's books, and there's quite a few of them, including John Cena. So you're in good company there with children's books. All right, Jay, you got something else you want to plug?
No, I gave Mauricio mine. But I do want to point out.
So you're going to plug Mauricio's wife too? Nice.
I'm going to plug Mauricio. I do want to point out that, okay, I just bought the book, so I'm the first. I will like and subscribe.
Love it. Love it. Love it.
I will both like and subscribe this episode. So everybody else is playing catch up. Go buy a copy of the book, like and subscribe to the channel, and leave a comment.
Wow. Hopefully the prize is some sort of free legal work, because we could use that.
Oh, it'll be good. It'll be good.
If I win, I will donate the prize to whoever came in second.
Wow. Awesome. Appreciate it.
All right, AJ, you got something else?
We are getting ready to wrap up our fund 2, which is just a portfolio. It's not actually like an open fund or anything.
Is it a customizable fund? Is it customizable?
Oh, no, I would never, ever do that.
Kyle needs something to invest in.
Yeah. I'm not investing now.
Kyle's like, I'm out.
And for that reason, I'm out. All right, I'm going to switch it up then. And it sounds like fun plugging Mauricio's wife. So I'm also going to plug Mauricio's wife tonight.
No, I'm missing out.
Yeah, AJ's missing. Well, I think she only needs 3 guys plugging her. So I think that's enough. So there's not enough room for a 4th. So go check out Mauricio's wife's book. I assume we're going to put the link down below in the YouTube. So it's a reason, if you're listening, go check out the YouTube video and find the link and go pick the book up. I don't know about you guys, but my drink's gone. It's a bit of a long episode here, so I really got to go hit the head. But even though I'm traveling next week for my birthday to go watch the Eagles beat the Seahawks, I will be making it, I think, from the airport. So I will see you next Tuesday.
See you guys.
See ya.
See ya.